Hello everyone, welcome to the live video for the Gamma Optimizer room. As usual, first question is sound check, video check. Anyone can type. You can hear me well and you can see my screen. I mean, for those of you that don't know, you can type it as a question, no? And just in case guys are seeing my video. Okay, seems that I don't have any confirmation yet. I don't want to start the video. At least one of you guys, don't be afraid. Just type on the questions if you can hear me and if you can see my screen. Okay, now I got one guy. Okay, let's start. What we have for today. Okay, in terms of close positions, we have no trades, no official trades. No, I've been doing during this week just to pass the time while I was doing all the other nets. I was doing nice one, which is actually really good. No, I think it worked most of the week, 4 out of 5, 4 wins out of 5, so it wasn't bad at all. But I still don't have like a solid system that I would like to share with the room. But we have a bunch of systems and some of them perform really well. And I know some users are doing their own thing. They're using NAS1. So, well, so for the meantime, that's what you have. No close positions and just doing NAS1 for fun. Okay, now let's look at the market regime. In terms of what the market is doing, the GT level is just moving a little higher from last week. But the market has been flipping back and forth, long gamma, short gamma. Interestingly enough, the long gamma regime has had the upper hand during the whole week. No, basically any short gamma flip was really short-lived. It was probably intraday or only one session, and then the market immediately recovered the long gamma regime since lots of buyers came into the market. But it seems that the dynamic has been broken since yesterday. Now we flipped short gamma yesterday, and today we remain short gamma. That's kind of interesting. That's something that we should keep an eye on it because it is at least a tad different than what we used to have before. No. So that's kind of what we are doing, and we are short gamma right now. And it is surprising because in 2023, short gamma has been very scarce. No, most of the time we have been long gamma. So something to keep an eye on. And my gut feeling here is that the market should come back to long gamma pretty soon, probably next Monday. If it doesn't, then I don't know. Then maybe this whole start of this year was completely fake, because usually when we have a nice long-lasting bull market, we are always long gamma. And so let's hope that we can retake long gamma soon. Otherwise, we have to be prepared for a repeat of 2022. In terms of volatility, this is the thing that is very interesting. Remember that the way I compute this value on this slide is from close to close, the realized variance, what I call realized variance. Now, close to close values daily, and for the past month it has been 16.69, and for the last week 16.29. It's kind of really stable now. It's very stable. It hasn't moved much this year, even though the market has been kind of crazy at the intraday level. The market has been oscillating back and forth intraday, and close to close basis is not that bad, no. and it gives us interestingly enough, it gives us some variance risk premium. VIX is trading at 20.73, which is kind of elevated for the type of realized variance. Finally, we're getting some decent VRP. And even for 1 week, we also have some amounts of variance risk premium, which is actually really good. So I guess volatility still looks good close to close, and even VIX pricing looks good close to close at this moment. And I have a question. Do ultra predictions impact your thesis at all? No, I actually don't look at the ultra predictions. I mean, I am been looking at new ultras. That's something that I have been doing, but I don't have a new one. So if I got a really good ultra net that has I don't know, for 5 days probably is the one that I like the most because it gives us a whole week of visibility. So probably one ultra and one ultra 3, and then I might take a look at it. But right now I don't pay attention to it. You guys are the ones that actually keep using ultra, and some of you still extract some value out of it. But I don't know. I think that net is so old. I don't know if the predictions are good enough. So it's hard to tell, TC. But I guess in my thesis in general about coming back to long gamma, it has nothing to do with the ultra predictions. It has to do with if 2023 is really a different year than the past year. No, if finally buyers are coming back because they were in the sidelines, so they're coming back, then we have to be long gamma, and we have to be long gamma most of the time. No. But if we go back to short gamma regime and we start spending time short gamma and short gamma, this is going to be a repetition of last year. No, this is exactly how last year started. I mean, this is a month and a half later, but that's how last year started. We were short gamma at the beginning of the year, keep short gamma and close short gamma. No, so it's at least something to keep an eye on. In terms of the term structure, notice here how interesting the term structure looks. Remember, the red line is implied volatility from last week, and now the blue line is implied volatility for this week. Notice the massive collapse in the front. The front collapsed massively, and that's because they were overpriced in the CPI numbers, no? Which is very interesting. They didn't do anything. The CPI numbers basically didn't do much. Market had a bunch of volatility intraday, but it basically closed flat, you know. And notice how the curve repriced. It was a massive reprice, like 12 volatility points of repricing on the front. But also notice how the back of the curve is basically the same. Back of the curve hasn't changed at all, which is kind of surprising, no? Because if the back of the curve was being affected by the CPI release, it should have come down quite a bit, but it came down just a little bit, no? And also, it's hard to see there. Let me see. I always wonder if you can see my pointer, my mouse pointer. But if you can see here, notice how steep this thing is, no? This thing starts at 15 and it goes all the way to like 20 something. And there are bombs. They are hiding, but they are here. And I'm pretty sure those bombs are related to upcoming Fed meetings, no? Or upcoming CPI releases. I guess the people are still expecting a little bit of action based on what the Federal Reserve does. But I guess in terms of the term structure right now, it looks very normal. It looks actually really good. It looks like dealers are not expecting much in the next 25 to 30 days. And then after that, it seems that they don't know what is going on. It's pretty much flat, you know? So that's what we have in terms of term structure. And personally, I think that dealers are not pricing options correctly as usual. No, I don't think they are doing a good job, a particularly good job. At least it's not terrible like last year where they were completely out of step with volatility. But I think options should be a little bit more expensive. No, just a tad bit. In the contango curve, yes, I think contango is okay because I don't think for a while, for a few weeks at least, we are going to have any type of event or macro numbers or anything that will impact volatility. But at least I will personally be adding a little bit more of implied volatility to this. So let's see here. In terms of realized variance, this is where you can see why. Notice how realized variance is. Remember this particular graph, the one with the blue line, is different to the other ones. This one is computed intraday, and you can see how crazy the intraday thing has been the whole year. No, we have kind of a quiet start to the year, and then February has been crazy. You can see all these massive oscillations here, and pretty much nothing below 10, just a little. We crossed twice below 10%, the magical, the mythical 10% level of adequate liquidity. And yet, you know, we always keep going back to something higher than that. So I think that the year is still kind of crazy. I was expecting realized variance to be settling a little bit more. I was expecting volatility to be a little bit more stable, but now I think I was I was I was expecting too much of the market, I guess. I guess I always keep hopes that volatility will return to the SPX, but I don't see that thing coming back. But in any case, this is something that gives me pause in terms of the long thesis. No, if the market truly was in a sustainable uptrend, we should see much better liquidity, which will translate in lower and lower realized variance. We should see this kind of this blue line, which we see at flatlining. And flatlining, even if it's above 10%, but at least remaining oscillating around 10 and breaking it if possible. Now, that will be like a great indication that maybe we can have an upside. I don't know, at this point, I'm a little out of step with the main predictions of the room. I don't know exactly in what count we are in terms of the Elliott wave counts. So I don't know if we are within what they are expecting, but in my case, I'm still expecting a little bit more upside, but who knows, no? We'll see next week what kind of realized variance and we can get. Okay, variance risk premium. In terms of variance risk premium, notice how stable it has been. I'm surprised that it's still positive. We haven't flipped negative in terms of VRP, which means that dealers are doing a better job than last year. Last year, we flipped negative pretty soon. This year, where it's remain positive, very low, but positive, no? So notice here we have a dip because we got a very unstable week a couple of weeks ago, no, or a week ago, and but it's still positive. So I guess dealers are doing a better job, and I could offer the explanation that perhaps the modeling is much better. Perhaps they have much more better software modeling for options, and that's why the variance risk premium is not as high as it used to be. That could be an explanation, no? But at least it's positive, so they are making some money, and they are not overpricing options that much. So I guess in that sense, maybe they are doing a better job, no? So that's kind of in terms of variance risk premium. Now, in terms of the trade plan, well, so NASDAQ. NASDAQ, I was doing the final tally was very close to 50%. I think it was just even money. But I guess I was not comfortable with the system being so unstable. It took two retrains very back to back, basically. And the second one went max drawdown in a couple of weeks. I guess in 3 weeks it went max drawdown. So it was too fast to go max drawdown. So that's why we don't have an official system. For those of you that pay attention, that have a good eye, you remember that I retrained NAS1 at the same time, pretty much around the same time I introduced the retraining of NAS10, and it has been performing amazingly well, in particular in February. That thing, NAS1 has been doing fantastic in February. And this week is the system that I've been trading. So I am not tracking it as an official system, but if you guys want to do something for now, I'm doing NAS1. In terms of what I'm basically training during this week, have been training nets around the noon time. Now, instead of 10 in the morning, noon, because I got a request from some of you that it is a much better time to trade, and I'm getting more or less the same results anyway. No, it's not perfect, it's not terrible. So I have a few, probably a few. No, I have like 6 different nets for noon that they are okay. And maybe next week I'll provide some data sets so you guys can help me decide what is the one we want to trade. It's always a trade-off, no, with neural nets. It's always a trade-off between probably stability, protecting overfitting, and longer lasting, not having to train them. And then you have to trade off that with precision, no? Because you get extremely precise nets if you are willing to retrain it really frequently, or you can have like a normal decent precision that only retrain every few months, no? So, well, we'll test them next week. that's kind of my plan. We can do this next week and test. Now, in terms of the variance center, let's see what we have here in the variance center. Okay, so the day is a down day. We are short gamma. Um, Despite being short gamma, really the imbalances are not that high. It's only 10 billion to the upside, 26 billion to the downside. The surprising thing is extremely low realized variance. That's something that I don't know. It really doesn't fit with my expectation. Even though we are kind of neutral, no, we are kind of neutral. The extremely low realized variance is telling us that during this particular sell-off, on this particular down day, there's plenty of liquidity. No, it's tremendous amounts of liquidity, which is kind of surprising. So I guess some people are snapping anything that is being sold. No, they are offering really good liquidity, and this is really interesting because in the way up, the days we had been massively up, liquidity was terrible. We have high volatility in the way up, and then we have low volatility in the way down. I don't know what is going on here. I really don't know what is going on. It is interesting. I guess you have noticed this. Realized variance is not only low from the beginning of the session, but it's extremely low in the last half an hour. It's only 9%, which is actually consistent with a Friday. No, Fridays are days that there is not much trading. Fridays are days that are calm. So it's consistent with a Friday, but I cannot surprise because the market is down, what, 1% down? I forgot. It's probably a little like 1%. In terms of gamma imbalances per strike, it's very interesting what is happening here. Maybe you can see my mouse. Notice that there is an area around, and this is strike, 4,065. That strike is full of calls. So I don't know what is going on there. I guess, are they buying calls for today? That's what they are doing. Like the market is trading right around that strike, and it's very interesting that I was not expecting it, because mostly you have a clear separation between long gamma and short gamma. Here, this area, you can see the calls, and they start around 4,150, and then it's a clear separation with puts on 4,050. No? But then you have this kind of weird thing here, like 4,065. I don't know what that is coming from. That's a weird strike, and clearly the market has been oscillating around that value for a while. No, so that's the only thing of note that I have, and it's probably expiring today. We already have the main standard expiration this morning. So this is only weekly options, but as you might know by now, weekly options are the thing, no? It seems that everyone is on the weekly options right now. And I got questions about zero DT. I'm going to use this opportunity to discuss a little bit about zero DT, which is a question that I get a lot. Zero DT is not a new concept, no? Zero DT has existed since options exist. Zero DT just means 0 days to expiration. And even when we only have options every month, there was one day of the month that we have zero DT options. No, it's just basically trading options the same day they expire. Okay, and it has existed forever and ever. Now there are plenty of techniques for trading options the same day they expire, and in fact we did. NAS10 is basically some kind of zero DT trade, no, because we were doing some intraday trade. But it seems that it has taken off recently in single names and even in indexes now, and they are very different. The activity in single names, the activity in stocks like Tesla or Apple or whatever, is mainly retail driven. No, bunch of retail people, they buy calls that expire the same day, very cheap, and they are trying to collect the lotos. Now they are doing lotto trading, which is okay. But there is interesting activity at the index level. At the index level, I'm really noticing massive amounts of trading of options that expire the same day, like flows that are gigantic, and you will need serious amount of capital to trade those flows. So clearly some institutional traders are moving into the space. To me, the effect is not really clear at index level. I don't see how clear the effect it is, because the SPX index is massive, And in order to actually move the basket, you really need tons of money. I mean, we're talking about serious amount of money to move the market, but there is an impact. I see the flows. And I have a question. Is there anything to learn from the morning options that expired today? I gather you don't have any view that has formed as a result of those expiring. No, not really. The AM options are mostly relevant every quarter. You know, when you look at the morning expiring options, the ones that we have to pay attention are the ones that expire in December, in March, in June, and September. No, those expirations do have an effect on the market, although it might be changing now. No, but traditionally, most of the gamma on the index trading has been on those options, on the morning expiring options on December, March, June, and September. The ones for February, I don't know. I never pay attention to the standard options, to be honest. And recently, weekly options have been really overtaken in terms of gamma. They have been really overtaking the standard. In fact, you can see that JP Morgan, they have a massive trade that they put every quarter, and that trade is using weeklies, which is very interesting. And they could have used the AM expiring ones, but they decided to use the weeklies instead, and I guess they kind of make them more, what is the expression now? They legitimized weekly options if you have someone as big as JP Morgan doing it now. So it gives some legitimacy to trading SP weeklies. But we have been trading weeklies since 2016, I guess, in the Gamma Optimizer room. We have been a little pioneers of that. So anyway, that was kind of my little rant about 0DTE. I don't really have much visibility yet in index. In stock options, they really cause tons of short gamma squeezes now, because stocks that have lower liquidity, they are easier to move. And if everyone is piling into the same option, then or dealers are hedging and they can actually move. But in the index, I guess it's tough. It's tough to move the index. Okay, so that's kind of what I have for the Variance Center. Last one seems to be bearish today. I'm gonna take this trade today, just in small size. I don't know. Hopefully we bounce into next week, but I'll take it because just in case my whole thesis of the market being different this year than the previous is wrong, and we're going to a sustained short gamma regime for one more week. Okay. So this is pretty much what I have here. Let's go back to Keynote. Okay, and I think that's all, folks. This was a very short meeting. Not many questions, I guess. So I appreciate you guys joining. Thank you very much for coming here. I'll have something for us to trade officially next week. Hopefully something, I don't know, I've been trying to look for something that really loses less, because I know that in a even money trade, there is money to be made. And I think that at the end of the day, most of the systems we have, they have made a little bit of money. But the problem with even money is that the amount of failures. Now, these trades fail a lot. So looking for something that wins more. No, even not necessarily wins more money, but wins more times. It helps psychologically, and it works with me. No, I love to trade that win all the time, even though I don't make that much money, because it helps with the psychology of trading. So we'll see. Next week I'll have something for you guys on Monday. Thank you for attending. I hope you have a great weekend, everyone, and I'll see you in the room. Take care, everyone.